The TEK2day podcast is brought to you by SS&C Technologies, a global market-leading provider of cloud-based investment accounting software services in fund administration. SS&C's AI-powered investment operations and accounting platform, Singularity, provides real-time, multi-basis accounting across a wide range of asset types with unparalleled automation and operational efficiency. Singularity is offered on a software-as-a-service basis or via SmartSource, SS&C's intelligent middle and back office accounting service. For more information, visit ssctech.com/singularity. Welcome to the TEK2day podcast powered by CEO Radar. It's your host, John Mayetta. Tech is not Teflon. So those investors that believe that the technology sector is impervious to any economic downturn are incorrect. And that will play out over the course of this June quarter earnings season, over the September quarter earnings season, and in Q4. And thus far, Q2, insofar as the tech names are concerned, the way I've said, I think it's going to play out. My guess is that is, in fact, how it will play out. So my expectations haven't changed over the past few weeks. And what I believe is what you saw last night with Snap is what you're going to see from many technology names. And what I mean by that is, as these technology companies report the June quarter results will be more or less in line with consensus estimates. I think the street was conservative enough in most cases as it relates to Q2 estimates. And for the most part, I'm focused on top line here because it's really more about demand when you're in a downturn like this, less so about earnings expectations. So I think Q2 is going to be fine. I think where you start to run into trouble is street expectations for Q3 and Q4 and calendar year 2021 are out of line. Expectations are too robust. Revenue is not going to snap back in Q3 and then be back to normal levels in Q4 with robust revenue growth in 2021. Neither of those three outcomes are going to happen. I think depending on the company, Q3 versus Q2 is flat to a very modest improvement. Q4 to Q3 sequentially, depending on the company, is also flat to a very modest improvement, even though Q4 is typically seasonally strong. Seasonality doesn't play as much of a role when you're in a downturn and executives at your customer organizations have little visibility into their business. So you don't get as much seasonality at a time like this. I also think that what Snap did last night in terms of not providing guidance, not talking about its outlook in detail, you'll see many other technology companies do that. So I think it's going to look a lot like Q1, whereby those companies that provided next quarter and full year guidance on the Q1 earnings calls will continue to do so here in Q2. Those companies that did not provide an outlook on the Q1 earnings calls in large part will not provide an outlook here in Q2. Their visibility isn't any better. I think that's a mistake, by the way. I think you should provide a baseline outlook. I think what SS&C Technologies and IHS Markit, and there were a number of others, what they did around providing sort of a baseline expectation for the year, best case scenario for the year, and then a mid case scenario for the year. So, sort of best, worst, middle. I think that's how you approach it, right? I mean, that's how you would approach if you went to your CEO as head of a division or as product manager for a big new product introduction, and you're working through the budget with your CEO and CFO, you would provide a best, worst, mid-case sensitivity analysis. So in a perfect world, that's what we would like to see. Give us your baseline scenario, mid-case, and best-case scenario. And if you don't feel comfortable sharing mid-case, best-case, then just provide an absolute baseline and go, look, this is the worst-case scenario, and we believe there's probably going to be a little bit of upside. We're not sure where, we're not sure how, we're not sure when, but here it is. Rather than just say we have zero visibility, we're not providing guidance. Because when you do that, what's bound to eventually happen is you're going to have wide dispersion of estimates. So you are going to miss somebody's number, and you're going to have in that wide dispersion, the most conservative estimates are going to be ultra conservative, and they may cause investors to say, wow, is that worst case scenario, is that really possible? Does this business really have that much downside risk as it relates to revenue and earnings? Maybe we'll wait another quarter. As cheap as it looks, maybe we'll wait another quarter. And of course, at present moment, technology stocks are anything but cheap. So as we go through the machinations of working through earnings in the June, September, December quarters, for sure, we believe you're going to see a rotation out of these rich technology equities into whether it be value, whether it be fixed income, but it's going to be difficult to continue to justify these rich valuations when companies have extremely limited visibility into their business. So the fundamentals are going to start to matter more and more as time goes on. That's all for now. See you next time.